Hey, what's up guys? Hope you all are doing great today. Welcome back to the channel. If you are new here, my name is Frank Mularcik and I enjoy talking about dividend investing, stock market investing, but mostly focused on dividend investing here on YouTube. And I also discuss some of my spreadsheets that I use to track my dividend investing, and just trying to show you guys what I do with that and show you my process of investing. And I also do some stock analysis videos here and there to provide some information on specific stocks. So if you think you would enjoy that, definitely consider subscribing to the channel and definitely like this video as well, as that helps me out a lot. So in this video, we're actually going to be talking about the differences between dividends and share buybacks and the advantages and disadvantages of each. And then we're also going to be talking about what might happen in a scenario if a company buys back all of its shares, and if that's even possible to happen, and what would happen in that case. So dividends and share buybacks are both methods that companies use to give value back to their shareholders when they often might think that the shareholder is going to get the best return on their investment through that dividend or share buyback. So generally what this means is that companies will give dividends or share buybacks if they are a well-established company that don't have a lot of room to grow in their industry. So if there's a fairly new company that has a lot of room to grow, they're probably not going to do dividends or share buybacks because they would rather invest those profits back into their company. So basically a dividend is simply a share of a company's profit that they pay out as a direct payment to shareholders, and this usually occurs on a regular schedule. Usually for most companies it's every quarter. For companies that do pay dividends, some companies do pay monthly, but it really doesn't matter when they pay out. That's really arbitrary, I guess. And a share buyback is basically when a company just buys back its own shares and then takes those shares off of the market. So that basically means that there are less shares on the market to be traded and less shares in the possession of all the shareholders. And basically what that means is that each share that the shareholder has will be worth a larger percentage of the company, and likely that share will be worth a larger dollar amount. So that's another way that companies can reward their shareholders a little bit. Now the difference is that with dividends you receive that payment or that return on your investment whenever they pay the dividend. However, with share buybacks, that stock price may take a while to adjust upward because of that share buyback, and you really don't realize any of your gains on that. Since it's just stock price appreciation, you don't realize any of those gains until you actually sell that investment. So that's sort of how both of those works. So for dividends, obviously if you need some steady income, that's sort of ideal to have that sort of dividend, so you don't have to sell your shares and you can continue investing in these companies and they will still pay you a little bit. But for share buybacks, that might be better if maybe you don't necessarily need the money right now, but you want to have some gains in your portfolio so that in the future you can sell those when you need to. And also a dividend is like a guaranteed payment. So once the company announces that they're going to pay a dividend, that payment and that return to you is guaranteed. However, with a share buyback, it's really not as guaranteed because they can buy back those shares and that will likely increase your shareholder value, but something could happen after that that could affect the company's business model or something like that and cause your shareholder value to decrease. So your gains or your return on your investment with a share buyback really aren't guaranteed until you sell that position. However, if you're investing in quality companies that you believe in for the long term, then that shouldn't really matter. You should be confident that in the long term that company will do well regardless of the share buyback or not. So in that case, the share buyback is just an added bonus. So the biggest difference that can actually affect how much of a return you get from dividends versus share buybacks is basically a tax situation. So because of the fact that you receive dividends immediately once the company declares that, you're going to pay income taxes on that dividend immediately. So for me, I'm pretty young, so I really don't have that much income, so that's actually pretty good for me at this point to be receiving dividends. But in a few years I'm probably going to get a pretty good engineering job with hopefully a pretty good salary, so at that point dividends might not be as good for me because I would have to pay a higher tax rate on that. And then maybe when I'm retired, a lot later down the road, maybe my income would be a lot lower, so then dividends might be a better strategy for me then as well. But with share buybacks, you don't pay any tax, obviously, until you sell. So you really don't pay any tax on the return from the share buyback until you sell, which is whenever you want to. So if you are investing at your peak earnings, which would be when you pay the highest tax rate, and you get dividends, then those are going to be taxed at a higher rate than maybe if you waited until you were retired and had a lower income. So that's sort of how a trade-off with that can work. But in my opinion, I feel like that's not going to have a huge effect unless you're really making an absorbent amount of money that you have an absurdly high tax rate, and then when you retire you're making like next to nothing and you have an absurdly low tax rate, which I would personally think if you're making a lot while you're working, then you're probably going to be making at least a decent amount when you're retired too. So I mean, it's really something to think about, definitely, but for most people I feel like it's really not going to make that big of a difference. So for me personally, I think I'm definitely a bigger fan of dividends than share buybacks. I've said this previously in some of my other stock analysis videos where I was talking about how much other companies may have been buying back shares. And the main reason for that is that dividends just seem a lot more concrete, and the return on my investment that I'm getting because of that dividend is just more concrete, and I can just see it and feel it more when that happens than a share buyback where it generally will increase the stock price and increase some of the financial metrics of the company, like earnings per share, for instance. But it's really not easy to see if that earnings per share and stock price increase was due to the company just doing extremely well, or if it was because of those share buybacks. So that's sort of my position on it. I just like that concreteness of the dividend, I guess. So what does happen if a company decides to buy back all their shares? And basically what I decided, and with some research I came to the conclusion that it's really not exactly possible, and mathematically it doesn't really make sense, but basically there has to be someone who owns the company, right? And a share is just a piece of ownership. So if you got down to one share, eventually from the company continually buying back shares, if you got down to one share, that would mean basically one person owns the company, right? So that company, that basically means that person has all the say in what happens with the company. So that person basically says, me as the company, I want to buy that share from me as the person, and that just really doesn't make sense. Someone has to own the company, so even if it's not traded on the stock exchange and they take the company private or something, which I'm going to talk about in a minute, it just really doesn't make a logical sense to say that a company will buy back all the shares. Now, buying back the vast majority of shares, so there's just a few owners, that is possible, and that actually has happened. Companies have been private and traded on the stock exchange, and then they they were public and were trading on the stock exchange, and then they went private and basically bought back or bought out the shareholders. But we'll talk about that in a minute. And another thing I wanted to talk about is that it's unlikely that the company would have enough cash to support this. So let's say a stock is trading at $10 a share, and just for the example, there's 100,000 shares. So that means that the company would need $1 million of cash in order to buy all the shares. So if they had $1 million of cash, that means for each share that someone owns, that share is worth inherently $10 of cash. And likely that business has some other intrinsic value based on what its business is about. So it's unlikely that its stock price would be trading that low to allow the company to buy back all those shares. So the example I wanted to talk about with this was Dell Computer, and basically they went public in 1988, I believe, and were public for about 30 years. And then in 2013, basically Michael Dell, who was the founder, and he was the CEO initially, and then there was a period in the 2000 where he wasn't CEO, and then in the later 2000 or the first decade of the 2000s, he was CEO again. So in 2013, he basically decided he wanted to take the company private again, just to focus on reorganizing the business, I guess, and not having to worry about answering to the shareholders, basically. So basically what he did is he worked with a private equity firm that helped him finance this, and they basically bought out all the shareholders, which is what I was talking about before. So basically, the stock was trading for around $14, and they basically paid everyone around $14 in cash for each share that they owned. And so there were still some shares left technically, because following this, Michael Dell owned about 75% of Dell, and then there were some other owners who owned some other fairly large percentages as well. So then after that, they basically delisted it from the New York Stock Exchange and went private. And then actually in 2018, they went public again, which is kind of interesting. So they're public now again. So I guess in conclusion, basically it is not possible to buy back all the shares of a company, but it is possible to, I guess, buy back the vast majority of shares. But however, that does have the caveat that all those shareholders have to be willing to sell. And if those shareholders aren't willing to sell, then basically the controlling owners of the company, those who own the vast majority of the shares, or who have together a majority, they would have to all vote together to take the company private and basically buy back or buy out the remaining shareholders. So it's a pretty complex situation, but it could sort of happen, and it kind of did happen, I guess, with Dell Computer. But they did take take out a big loan with that private equity firm in order to get that to happen. And the quote of the video is, "Try never to be the smartest person in the room, and if you are, I suggest you invite smarter people or find a different room." And so this one was actually said by Michael Dell, who's the founder of Dell Computer. So I was actually just doing some research about that Dell privatization, and I just came across this quote, so I thought I'd include it because I really do believe in it, that you have to surround yourself with people that are better than you in everything, smarter than you, wealthier than you if you want to become wealthy, in order to make you better, because you're not going to learn anything if you already know more than everyone else. So you really have to surround yourself with people who know a lot more than you, and that's how you learn and grow as a person. So I really enjoyed this one. I hope you guys enjoyed the video as well, and I will see you in the next one.